Well, good day. Thank you for joining me at this weekly live event. Another big week, and one that's been dominated by China on this occasion rather than the United States. So I thought that's where I'd go and concentrate a lot of my attention today. We've seen the big monetary stimulus package being implemented on Tuesday, cuts the loan prime rate, triple R, MLF and the like. And then yesterday, we got the big bang when it came to the fiscal side of the equation. We've got a few details we can go and cling on to right now, but it looks like the markets, at least, are pretty happy with it, although we're not seeing a lot of excitement when it comes to the growth trajectory moving forward. With that, let's just go and get straight into it. I'm going to go and get on the screen right now and have a quick look at what the bond market is saying about the package first of all. And it's really informative as to what is impacting this particular information right now. So for those who haven't been aware, the rumors at the moment, we haven't got any concrete detail about the size of this fiscal stimulus package coming through from China, but Reuters reported yesterday that there's potentially going to be 284 billion worth of sovereign bonds issued to go and fund this fiscal stimulus coming through. Now, what does that mean? Well, it equates to around about 1.5% of Chinese GDP. So it's a decent size, but nowhere near the kind of big stimulus that we saw back in the GFC and the like. And half of that amount is apparently going to be flagged to go and deliver to relief for local government agencies, which are heavily indebted at this point in time. And that's partly to do with what's going on in the property sector. So only half of that 1.5% of GDP that's been flagged is actually going to go and be devoted to go and try and stimulate domestic demand. So what does that mean? Well, right now you can see at the moment, we've got on the left-hand side here is the government bonds in the in China going from 1 year all the way out to 30 years at the top here in blue. And it's on a daily tick, so it's a lengthy period of time. But there's a lot of information that is contained in this particular, what the yields are telling you. So remember that you've got, when it comes to yields, expectations for economic growth, expectations for inflation, and then the further out you go, the compensation that you're going to get for uncertainty as to what the trajectory for both of those will be like in the future. When it comes to a sovereign bond market, we don't have that credit risk really attached to it. When it comes to China, of course, it can go and print its own money and get out of that particular problem. So what's the message being told to us right now? Well, the message right at this point is that even with this stimulus coming through and everything else, look where the 30-year bond rate is in blue here, 2.2%. That's very, very weak considering that the real GDP target for China at the moment is 5% of GDP. And then their loose inflation target on top of that is around about 3%. So it's 6 full percentage points below where you'd expect to see that kind of that yield trading at the moment. So just the trajectory is giving you a lot of signal as to where the market's going to see growth and inflation in China in the future. And you can tell why people are talking about Japanification of China and the like, being able to really struggle to go and get out of this debt trap and trying to go and struggle to go and generate inflationary pressures given household debt levels, given poor demographics and the like. So right now, whilst the markets are getting very, very excited about what's going on, the bond market is still signaling, well, hang on, we're still not getting really, really excited about the prospect for a meaningful recovery and an increase in Chinese economic growth. They're looking for structural declines coming through at the moment. So that's something to go and keep in mind longer term, but in the near term, things are looking a little bit brighter. On the right-hand side here is the Chinese 2s10s curve. Now, there's no real signal in it when it comes to recessionary signal or anything like that, like the focus is in the United States. But for me, this is giving me some kind of confidence that whilst growth expectations are diminishing over the longer term, nearer term, there's expectations that we might go and see a reflationary environment, albeit not massively so. So what's it telling us here? Well, it's basically saying that longer term yields are starting to go and move higher than shorter dated yields. So that again is giving you some information about where markets see the trajectory for economic growth and inflation moving forward. And you can see even before this particular announcement's made this week, we'd already seen that curve starting to go and steepen up. So you can see the reaction over the course of yesterday. So I made a video yesterday looking at some of the Chinese markets, and I said that the markets need to go and see some concrete fiscal stimulus plans coming through. Otherwise, we run the risk that we might go and falter again and pessimism will return to the economy. Well, you can see in response to that fiscal stimulus package, we've seen the 2s10s curve go and steepen by about 9 basis points. So that's a decent move. And so again, it just filters in to see like, no, at this point in time, we don't expect to see a massive recovery in growth, but markets are getting more confident about the growth trajectory and that China will be able to go and achieve that 5% growth target that has been flagged, of course, at the start of this year. Let's have a look at how it's flowed through to some of the other markets out there. And I'll kick off looking at the developed markets in the currency space, two currencies that are really, really closely aligned with the fortunes of China, and that's the Aussie dollar and the Kiwi dollar. I'm going to look at weekly charts because I just think that it gives you a lot more signal and message in it. Some of the price action, particularly in the Aussie and Kiwi over the past 3 days, has looked like a Richter scale, just constantly going back and forth. But when you go and zoom out a little bit, you get a lot more information. Hopefully that will be conveyed here. So Aussie, you can see for a start, well, it's really, really important today because look where it's sitting on the chart. So you can see here a number of resistance levels here around about 69 cents. Rejected. And then you can see here earlier this week, it broke its downtrend pretty convincingly. So now it's testing this level. And then look at this downtrend that you can see here on your screen. Now that goes back to the start of 2021. And it's been a long running downtrend. And the fact that it's sitting right here now, you can see that if the price was to go and break through this level, there's not a lot to go and hang your hat on the upside, maybe a little bit around 70.30 or so, but 71.35 you can see acted as resistance a couple of times over the course of 2022 on the weekly time frame. So to me, when you look at the Aussie chart, you've got RSI 14 is trending higher, higher lows. You can see here MACD has also generated a bullish signal when it comes to a momentum indicator. So you can see that when it comes to the bias for Aussie, on the back of these fundamental announcements that have come out of China, it's suddenly looking pretty good. And we can see that's also being transferred through across in the Chinese yuan against the US dollar and the like. So this is a really, really key zone. I'll go and zoom in a little bit so you can get a sense as to where we're at. But around about 69, just above 69, if we can manage to go and break above that, there really isn't a lot to go and speak of until we get back to the low 70 cents. And a lot of people have been looking out there for the Aussie dollar to go and find some meaningful upside. Well, potentially this could be it. Let's have a look at the Kiwi as well, because it's kind of in the same boat, a little bit different though. Again, it's had a pretty decent move. So you can see it's already broken the downtrend that was established back in early 2021. And then you can see that bullish breakout came back and retested it beautifully. And then you can sort a morning star pattern as well in the weekly chart. And then we've gone up and done a nice sort of straight through 63 resistance there. And then now it just comes down to a whole bunch of market peaks that are standing in front of us. So 63.70 is the next issue to keep on the radar. And then above that, you've got 64.12. And then you can see here, it's around about 65, just above 65. That's been a bit of a resistance zone. So you can see here, rejected pretty comprehensively, rejected once, twice, 3 times again. So around 65, low 65s is another area to go and consider if we get this upside going. And I think that based on what we're seeing right now, based on what we're seeing when it comes to cyclical patterns towards year end, unless we get some kind of outlier event from a geopolitical perspective or something like that, upside is far more favored in these cyclical currencies right now than downside. You can see here, again, RSI 14 trending higher. We've also got a bullish signal from MACD. So both confirming that positive momentum outlook. Let's have a look at Chinese markets specifically. We're going to stick on the weekly charts because some of the moves that we've seen this week, you need to go and have a weekly chart because it's just simply been that big. Let's kick off having a look at China A50. My colleague Max Simpson, who might be listening in right now, is writing up a piece about this right now. But I used to get his views, but you can see here, downtrend, straight through, and just look at the size of that bar, and then look at the size of the, have a look at the size of volumes going through as well. Yeah, it's been, so we haven't even completed the week yet, and you've got to go back a long way to go and see anything along these particular lines. So a lot of excitement downtrend broken. Now it's sitting above 12,939, which was a market peak earlier this year. Above, you can see 13,520 is an area that's been acted as resistance in the past a few times. 1, 2, 3, knocked back from that level. So on the top side, that's an area to go and keep an eye on. On the downside, any dips towards 12,939 maybe present a pretty decent opportunity to go long at these levels with a tight stop below. That's if you're in the market for that particular marketplace. Look, further above that, if we get a foothold above 13,520, you look back here, 14,493 is an area where acted as both support and resistance over the course of the pandemic era. So you can see here back in 2021, and then again through here, support, resistance. So that's one to keep an eye on as well. And then above that, just above 15,000, 15,009 was the peak that was hit back in 2022. When you look at the momentum indicators, look, clearly the downtrend in RSI 14 has been broken this week. You've also got MACD's flicked higher to go and confirm the bullish signal. So from a momentum perspective as well, things are looking good. We are approaching overbought territory on the weekly chart, and when you go into a smaller time frame, like a daily or even shorter, we're clearly really overbought on those time frames. So potentially you could go and see a pullback, but it's pretty obvious we've got a lot of optimism out there in the markets that might flow through, especially into Golden Week next week in China. It's a similar picture on the Hang Seng on the weekly chart. You can see here, long running downtrend that was broken this year. You can see came back, spinning around, then bounced off it, and then we've just had this big move this week. Again, on the back of pretty decent volumes coming through. We're actually overbought on the weekly when it comes to RSI 14. I do have a bullish signal coming through as well from MACD at this point. You can see it's managed to go and clear some market peak levels, which could have acted as resistance. The latest being 20,496, you can see, was the peak back in August this year. So we're now sitting at multi-year highs for the Hang Seng, which is quite an achievement considering where we were just a week or so ago. Now, above, you can see there's not a lot of levels to go and hang your hat on. Maybe around about 21,500. You can see that the price did some work either side of that. While I'm here, might as well go and put it in. And then above that, you can see, so that would be the first upside target for me. You can see that the price hit, rejected, through, back test, bounced, then finally back through. So around about 21,500 is a level to go and keep an eye on. Above that, 22,975, which you can see was the peak back in late 2022. Again, from a momentum indicator perspective, things look pretty decent when it comes to the Hang Seng at the moment. And we know that it's very retail-driven markets as well. So there's likelihood that we could go and really extend without having institutional involvement looking to go and sell into it. Clearly, with momentum behind it, with the fundamentals that are still out there, and just given the sheer amount of announcements that are coming through from Chinese officials right now, you don't really want to be standing in the front of that trying to go and stop the other downwall. There's clearly a lot of optimism, and there's been a lot of pessimism that's been built into these prices for a long period of time. Let's get to the commodity space, and being in Australia, let's have a look at iron ore. Now, one of the announcements that really stood out to me yesterday was that the Politburo said that they did not want to go and are going to closely track and limit the amount of new builds in the residential space. Now, residential property construction in China was the single largest source of steel demand globally. So it's a really important factor, not only when it comes to industrial metals, but clearly for iron ore. But yet iron ore has rallied pretty strongly in the back of it. Record volumes going through the SGX exchange at the moment. You can see it, momentum indicators, RSI 14, higher lows being printed here. And you can see here when MACD, it's about to go and crossover as well. So things are looking pretty good at this point in time. Downtrend on the weekly time frame has yet to be breached. So keep a close eye on that. At the moment, this zone here, you can see there was a market peak back in August this year, around about 103. This zone here is going to be an area that's going to be very important when it comes to the longer term trajectory for ore. Will it be able to go and bust through this level and then potentially run up to 113.50 or something like that? Or will it be rejected again? At the moment, it's hard to go and say from my perspective. The price signals are looking pretty good right now, but from a fundamental perspective, nothing has really changed. Yes, they're going to go and try and support property prices, which is important for established property prices, but again, restricting supply of new builds is not something that is bullish for iron ore longer term. So yes, there's a lot of excitement right now. Yes, iron ore is tracking pretty closely the listed developers in Hong Kong markets. But yeah, there's something about it that I'm still not entirely comfortable about. If we were to go and break this downtrend pretty convincingly and manage to go and push above that, maybe the price signal alone will go and change my tune. But the filters that I apply on both the fundamental and technical side, right now, the technical signal's not giving me enough impetus to go and get really bullish about iron ore right now. Let's have a look at COMEX copper as well. It's a nice bar. Not accompanied by massive volumes. Yes, bigger than what we've seen in the past. But you can see here early in the year, the copper squeeze and the like that was going on. That was really, really massive volumes going through. We haven't seen that yet, but a good sign for the bulls is that we're seeing here the volumes are starting to go and pick up. And the price action, of course, this week has been undeniably bullish. This area here, $4.40 a pound, was pretty important. Broke above that, and we've just gone on with the move at this point. You can see the downtrend as well. Imagine line here, we've broken here. So you can see here that's starting to go and push higher, trend higher. MACD is also about to go and confirm that bullish signal. If not quite there yet, but it's getting very, very close. On the top side, if you're having a look at that, I'd have a look here at this point. I can just see on the screen. You can see that around about 455 or so acted as resistance, support. So 455 would be one level to go and keep an eye on if we do see a pullback. And then on the top side, 477.80 is where you can see the price did a lot of work. Rejected, through, break, retest, down. So 477.8 is the level that you want to keep a close eye on. Above that, we start talking about the double top around 531, which was the record highs that we saw in 2021, and then again in 2020, earlier this year, came very, very close to reaching that particular point. So things are looking really, really good on the industrial side of the equation right now. If anyone has any questions about Chinese markets or any of the other markets that might go and benefit as well, please wait to the end. Shoot them through on the platform here, or get on Twitter as well, and maybe go and put any questions in as well. I'm happy to go and look at them towards the end. The other thing I'm going to go look at is the United States, the other big economy in the world. And we know that it's been a relatively quiet week when it comes to economic data. A lot of Fed speak, but nothing to really go and change the picture. But something really interesting happened last night that I think is worthwhile touching on, because it's also a reminder not to get too pessimistic based off one data set. Having a look on your screen now, this is Fed funds futures curves. So basically giving you an insight as to what's being priced for various timeframes. On the left here is what's being priced for the remainder of this year in terms of pricing. And then on the right is expected easing from the Fed over the next year and a quarter out to the end of 2025. Still around about 83 basis points that are being priced into to the 2024 curve, and still 224 into out to the end of 2025. So a lot of cuts still being priced. But you can see this week, and particularly yesterday, a bit of a move higher, around about 5 basis points or so in this particular curve for 2024. Not so much when it comes to longer term trajectory. And that was because we got the final read of Q2 US GDP. Now, it was bang on the previous estimate, 3% when it came to expenditure measure. But the really, really interesting thing was that the incomes, so the GDP incomes, there's 3 different measures: production, expenditure, and incomes. The incomes one was initially reported as being very, very weak, but that was actually revised quite substantially higher. So instead of being around about 1.3% annualized in Q2, the income measure of economic growth was reported now at 3.4%. And that's important because the flow-through effect is that rather than having really, really depleted household savings, the estimate now, instead of being 3.3% being saved, it's now 5.2% in aggregate across the household sector. And when you talk about the potential to go and fuel economic growth and to go and keep the labour market relatively tight and prevent a big increase in unemployment, it needs to come down to the US consumer. And the fact that we've got an upward revision, there's more firepower, there's more in the tank to go and fuel spending. The labour market, everyone who has a job, wants a job, has a job right now. That's kind of a potent mix. And just a reminder, to not get too pessimistic about the US economy right now. Even when you look at the Atlanta Fed GDP now forecast at this point, it's still pointing to a seasonally adjusted annualized pace in Q3 of around about 3% per annum. That's a full percentage point and then change on what is deemed to be the level that would go and keep unemployment and inflationary pressures relatively stable. So things are looking pretty good out there. So just be getting too bared up about the US economy right now, because some of the information we're seeing at this point is not really underpinning that particular mindset. But things can change pretty quickly, because we know the Fed is paying really close attention to what's going on when it comes to the labour market. So next week, it's going to be a big one. I'm just going to go and have a quick look at the calendar here. Straight to the USA, not to go and discount what's going on elsewhere in the world. It's going to be a busy week. But just to go and remind, this week, to go and end off, we've got the core PCE deflator from the BEA, which is going to be scrutinised, but maybe not as heavily as the past, because we know that the Fed has got much more of a focus on the labour market right now. But just remember what I was talking about when it came to the household savings ratio and more income that's being saved to potentially be deployed to go and spend. Arguably, the personal income and the personal spending data in this release are going to be just as important, because that is going to go and feed through to expectations for growth. And then as a byproduct of that, it will also help to go and feed expectations for the outlook for what's going on in the US labour market, which we're going to go and get a lot of information on that front next week. As you can see, just go flick forward. Let's go and take it off. Now, being the start of a month, we know there's going to be a lot of new information. And I'm not going to go and touch upon the payrolls report, because next Friday, that's exactly what I'll be talking about. But right now, you can see that there's going to be a lot of new information to digest coming through, particularly on the labour market. You can see here, let me go and put it to US time, New York. So you can see here, Monday, Jerome Powell will be speaking at 1 o'clock in the afternoon. Again, he did pre-release last night, didn't go and give us anything new about the monetary policy outlook or his thoughts on the economy. But anything that he's touching at the moment, we know that he tends to go and lean a little bit more dovish than I think most FOMC members at the moment. There's an opinion out there that he dragged a lot of the FOMC members towards that 50 basis point cut based on what he was talking about at the Jackson Hole Symposium in August. So keep a close eye on that. But then you start looking at some of the data releases that come out, and we're going to get a lot of information about the labour market in the States. You can see here, ISM manufacturing, it's a very small part of the US economy, around about 10% or so, but that's going to get a lot of attention. JOLTS, job openings, we know the ratio has fallen from around 2 to 1 to 1 to 1 when it comes to unemployed worker and vacancy, or 2 to 1 at the moment. So there has been a bit of a shift there. The labour market is definitely showing signs of loosening up. It's quite a volatile series. To me, the quits is going to be a much more important measure, because in terms of confidence in the United States labour market, you don't typically quit your job unless you feel confident you've got a job to go to. So keep a close eye on that particular measure in that release. But then you look, a lot more Fed speak coming through as well. I'm not going to go over it because they're going to be reacting to the data just as we are as well. Then ADP employment change on Wednesday. The precursor to payrolls, it's a private sector measure. In the past, it was horrible. It would give us really, really bad reads on what payrolls are likely to produce. But then, as we've subsequently seen, around turning points in the cycle, the payrolls report has been pretty lousy as well. And they've retooled the ADP employment survey, and it's now not a much more decent guide, in my opinion. So that could actually be really, really quite market moving. And you can see at the moment, previously it was 99,000, a very, very weak outcome coming through. If we were to go and get another outcome like that from ADP, or worse in the private sector, you know that the markets are going to be piling into much greater bets when it comes to the size of the next move from the Fed at the start of November. If we got a weakness in that particular report, I would not be surprised to see the markets really move to shift into a 50 basis point and make that the clear-cut favourite. Apart from that, you can see here as well, challenger job cuts, always interested to see the level of layoffs. We know that most of the increase in unemployment that's come through recently has generally been from entrants into the labour force rather than those who actually are in there at the moment. Jobless claims fell to multi-month lows last night, 218,000. So there's no sign of widespread layoffs being reported as yet in that particular series. And then we start getting to the far more important ones. ISM services read, the biggest part of the US economy, around 80% plus. This is going to go and give us some really, really good insights. The employment picture, 50.2 last time, so almost unchanged in terms of hiring levels. That's going to be one of the areas to keep a very, very close eye on as well, along with, of course, the headline and things like forward orders that potentially portend to what's going to go and happen when it comes to demand moving forward as well. And then, of course, moving in, we then get to the payrolls report, which is going to be huge on Friday morning next week. I'm not going to go and get into that because clearly that's going to be something we'll focus on next week, and we'll see what happens when it comes to the data beforehand. So we've covered off China, we've covered off the United States. At this point in time, I'm very happy to go and have anyone who'd like to go and answer any ask any questions of me. I'll go and put up the disclaimer on your screen now. Just a reminder, everything here is general in nature. I'm not taking into account any of your personal circumstances, and anyone who chooses to partake in this particular part of the live event is doing so at your own will. I'll give you a few minutes to go and have a quick look at that. If anything comes through, I'm happy to go and oblige. Otherwise, we'll wrap up. Looks like everyone's a bit tired out there. Well, let's go leave it there. Thank you so much for joining us today on the YouTube live event. Look forward to going and joining you again next Friday, hopefully with the Sydney Swans victory. And of course, my North Sydney Bears as well are playing in the grand final for the New South Wales Cup. So best of luck to them as well.